All right, let's get straight into it. You are looking at a chart that has effectively rewritten the playbook for the entire media industry overnight. Warner Bros. Discovery is currently sitting at $26.08, up over 6% in the last session, and if you are wondering why the ticker tape is practically glowing green while the rest of the legacy media sector looks uncertain, it is because the rumor mill didn't just spin, it exploded. The headline reality is here. Netflix is acquiring the studio and streaming assets of Warner Bros. Discovery. This is the moment where we have to pause and separate the expectation from the reality, because the delta between what the market thought would happen to this company and what is actually unfolding is staggering. The general expectation for the last 18 months was that Warner Bros. Discovery was a trapped animal, loaded with debt, tethered to a dying cable bundle and desperately trying to cut costs to survive. The narrative on Wall Street was that CEO David Zaslav was effectively stripping the company down for parts just to pay the interest on the loans. Investors expected a slow bleed, perhaps a minor asset sale, or maybe, just maybe, a messy merger with another struggling legacy player like Paramount. That was the expectation, a defensive, survivalist move. The reality? The reality is an aggressive, industry-shattering offensive that completely redefines the value of content. We aren't just seeing a merger, we're seeing a surgical separation and a premium acquisition. The deal structure announced, where WBD spins off its linear networks into Discovery Global and sells the crown jewels, Warner Bros. Studio and HBO, to Netflix, is a financial engineering masterstroke that unlocks value we thought was dead. The market expected a fire sale. The reality is a bidding war victory that values these assets at a premium. And that is why we are seeing this price action at $26.08. Let's break down exactly what this movement represents, because the volume we are seeing, nearly 100 million shares traded in the last session, tells us that institutions are repositioning and they are doing it fast. When you look at the intraday movement, the stock gapped up and held its gains. This is crucial. Often on buyout rumors, you see a pop and drop as traders take profits. Here, the price is sticking near the highs of the day. Why? Because the arbitrage spread, the difference between the current price and the implied deal value of around $27.75, is narrowing, but it still offers value. The market is pricing in a high probability of deal completion despite the regulatory headwinds we all know are coming. Now, let's talk about the mechanics of this trade, because if you are holding Tesla stock or Nvidia stock, you are used to growth-driven momentum. This is different. This is event-driven value realization. For the retail investor, this can be confusing. If you're sitting on your Robinhood app looking at your Robinhood investments, or perhaps checking your Robinhood cash management balance, you might be wondering, do I sell now or do I hold through the split? To answer that, you have to look at the why. Why did Netflix, a company that famously said it would never do big M&A, suddenly drop over $80 billion for this? Because the streaming wars are over, and the content wars have entered a new phase: consolidation of the library. Netflix didn't need more technology. They needed Harry Potter. They needed Batman. They needed Game of Thrones. By acquiring the Warner Bros. Studio, they aren't just buying content, they are buying cultural heritage. And for Warner Bros. Shareholders, this validates the thesis that the parts were worth significantly more than the whole. Let's shift gears to the fundamental picture, because this is where the smart friend analysis comes in. You can't just look at the stock price, you have to look at the debt. Warner Bros. Discovery had a gross debt load that was suffocating the equity. It was the elephant in the room in every earnings call. The expectation was that this debt would drag the stock down to single digits, and for a while it nearly did, touching lows around $7.50 earlier this year. But the reality of this deal is that it solves the debt problem by transferring the prime assets to a cash-rich buyer, Netflix, and spinning off the cash-generative, albeit declining, linear assets into a standalone entity that can service its own smaller debt load. For those of you who utilize Schwab Intelligent Portfolios or engage in online investment strategies that focus on debt-to-equity ratios, this deal transforms the metrics. Overnight, WBD goes from a distressed value play to a strategic acquisition target. The heavy lifting Zaslav did over the last 3 years, the brutal cost-cutting, the shelving of movies, the restructuring, was all preparation for this sale. It wasn't about fixing the business for the long term, it was about dressing the bride for the wedding. Now, I want to take a moment to address the retail investors who might be using SoFi Invest or SoFi Active investing platforms. You might see this news and think, is it too late to get in? The answer lies in the regulatory risk. The Federal Trade Commission and Department of Justice, the DOJ, are the wild cards here. Expectation: the government hates big tech and big media mergers, so they will block it. Reality: the media landscape has changed so much that monopoly definitions are blurry. Is Netflix a monopoly if it buys HBO? Maybe. But with YouTube and TikTok dominating attention, the argument for blocking this might be weaker than it was 5 years ago. However, if the deal is blocked, WBD stock could tumble back to the mid-teens. That is the risk premium you are seeing right now. The stock is at $26.08, not $27.75, because the market is pricing in a high probability of regulatory veto. If you are managing your own individual brokerage account, say through Interactive Brokers Trading or using the Interactive Brokers platform, you have the tools to hedge this. You can look at the options market. The implied volatility on WBD calls is spiking, suggesting that traders expect more turbulence as we get more details on the spin-off ratio. Let's look deeper into the Discovery Global spin-off. This is the part of the deal that doesn't get the sexy headlines but is critical for shareholders. This new company will hold the linear networks, CNN, TNT, TBS, Discovery Channel, HGTV, Food Network. These are the cash cows. They are in secular decline because of cord cutting, but they still print money. By separating them, WBD is effectively creating a bad bank, good bank structure, but for media assets. The good bank, streaming and studios, gets sold to Netflix. The bad bank, linear, stands alone. Why is this brilliant? Because there is a class of investors who love yielding assets. They don't care about growth, they care about cash flow. Fidelity investment managers and those running Fidelity mutual funds or Fidelity ETFs often look for these high cash flow, low growth dividend payers. The new Discovery Global company could become a dividend aristocrat, appealing to a completely different investor base than the growth-hungry Netflix investors. This brings us to a crucial point about market psychology. When Apple stock makes a move, it lifts the whole tech sector. When Tesla stock moves, it lifts EVs. But when WBD moves like this, it sends shockwaves through the entire legacy media sector. Look at Paramount, now Skydance Paramount, or Disney. They're reacting because the valuation multiple for studio assets has just been reset. If Netflix is willing to pay this much for Warner Bros., then what is the Paramount studio worth? What is Disney's studio worth? This deal puts a floor under the valuation of legacy media, which is why we are seeing sympathy moves across the board. I want to pause here and ask you a question because this is the debate happening on every trading desk right now. Comment below, do you think the regulators will actually let Netflix own HBO, or is this deal destined to die in court? I really want to know your take, because the regulatory arbitrage is the biggest trade left in this name. Let's examine the recent institutional activity. We know that major hedge funds have been accumulating WBD in the $8 to $10 range over the last year. They were betting on exactly this outcome, consolidation. If you look at the Fidelity Wealth Management reports or data from Fidelity IRAs, you often see WBD held in value or turnaround baskets. Those funds are now sitting on a massive 100% plus gain. The question is, will they sell into this strength, or will they hold for the conversion into Netflix stock? The terms of the deal, cash and stock, mean that WBD shareholders will eventually become Netflix shareholders. This is significant. It forces a rotation. Value investors who held WBD might not want high-growth Netflix stock, so they might sell. Growth investors who want Netflix might not want to wait for the deal to close, so they might buy Netflix directly. This creates a fascinating tug-of-war in the price action that we will see play out over the next few weeks. If you are someone who prefers self-investing and relies on investment help from robo-advisors like SoFi Robo-Advisor or Schwab